So as a thought experiment, you could say, well, what if you already bought the insurance and all of your reference point had adapted? And then I come along and I say, would you pay me $100 to lower the deductible from $1,000 to $500? You're like, no, that's a ridiculously bad offer. But if you're already paying, I don't know, some $5,000 or $6,000 for the premium, yes, then the extra $100 seems trivial, which is in fact how you get hosed in a lot of markets, right? So if you go online to buy a computer, here's the base model. It's $1,000, right? Some laptop. Would you like to add this little, thumb thing? It's a completely ridiculous thing. Do you want to add an additional antenna, right? Do you want to add like a Mickey Mouse sticker? And what you ought to do, this is just a tip, is you ought to ask yourself this question with every single one of those. Suppose I already own this computer, would I pay this much to add this to the computer? And then what you're doing is you're basically resetting your reference point and taking yourself out of the diminishing marginal sensitivity pickle. Okay? So lots of things drive these kinds of goofy choices. But you still don't get the result without loss aversion. Okay, equity premium goes like this. There's two kinds of investments, roughly. There's what's called equity, which is stocks, which is you become part owner of a company, right? If the firm does well, your return is high. If it does poorly, it's low, so you have some risk. Alternatively, you can invest your money in debt, which is often called bonds, which is to say, right, these can be municipal bonds or treasury bonds, but they can also be bonds that are sold by a company. In any event, a bond is that you're basically making a loan to the company or to whatever government agency is floating the bond. If the firm does well, you get your principal plus interest. If the firm does badly, you get your principal plus interest, unless the firm happens to be called Detroit, in which case you get nothing. And the bottom line is that there's no risk. Okay? So again, you're choosing between a risky gamble and a non-risky gamble. Famous paper from 1985 took data from 1889 to 1978, and the annual return on equity over that period of time on average was 7%, and on debt it was 1%, so stocks versus bonds. And the difference between the two is what is called the equity premium. Okay, so why is it called that? Because it is the premium, the additional payment that investors require to take on the risk of holding stocks. Okay, so so the return is basically the return is the value to you of the thing, and you just basically are your risk aversion or your risk preferences say no, you have to pay me a lot more to give you this money under conditions of risk. So the paper, which I believe is on BSpace, Mehra and Prescott, and they did basically something very similar to what we've seen already in several situations, which was they took the standard model, that thing, and they said, okay, how much curvature would there need to be here to explain that risk premium, given how risky stocks actually were over that period of time? And the answer is that to explain the 6% premium, you would need a coefficient of relative risk aversion of 30, where most real-world estimates are closer to 1. You're all thinking to yourself, what did that mean? That one went over my head. CRRA, sorry, not CRRA, the coefficient of relative risk aversion. Coefficient of relative risk aversion. I think it is now 88 degrees in this room. For any given utility function, u of x, is equal to negative x. It's negative x times the ratio of the second derivative of the utility function to the first derivative. The second derivative being negative, this just makes it a positive number. Okay. So basically what it's saying is, tell me the curvature, and then let's sort of normalize that by the actual slope, so we get something that gives us the same number wherever we are in the income range, and then multiply it by x. Multiplying it by x does something really interesting, which may not be immediately intuitive. Okay? This is the marginal utility of wealth, correct? U prime, first derivative of the utility function, the slope of that thing, that's the marginal utility of a dollar. This thing is the first derivative of the marginal utility of a dollar, right? So I can rewrite this as the negative of x times the partial derivative of marginal utility with respect to money over the marginal utility, right? Am I getting that right? No, sorry. Over marginal utility, right? Now, if you rearrange this, you get something rather lovely, which is you get the partial derivative of marginal utility with respect to money multiplied by x over marginal utility. Actually, get the negative of that. This is what? It's an elasticity. It's an elasticity. Can anyone sort of like look at that, squint at it, and figure out what is it an elasticity of and with respect to what? Give it a shot. No? What's x? It's this thing. It's the elasticity of the marginal utility of a thing with respect to the amount of that thing you've got, which is actually the right answer, and we'll just call that thing money for the sake of argument. So it's the elasticity of the marginal utility of wealth with respect to wealth, okay? Which is to say, the marginal utility of wealth is how much a dollar is worth to you, and what this object is when your wealth goes up by 1%, how much does your marginal utility go down in percentage terms? Okay? So how fast does a dollar lose its value? That's what this coefficient is. It's telling you something about the curvature of this thing, and this curvature is telling you how fast your marginal utility is going down. The problem is because marginal utility has no scale, right? Because it's I don't mean anything. You have to turn it into an elasticity, and then scale doesn't matter because it's all in percentage terms. That's the same reason we do elasticities everywhere. Demand supply is because we then get to eliminate the units of measure, the scale. So in the real world, what people typically conclude is that the best estimate of the utility function is a log utility function, which has a coefficient of relative risk aversion of 1. You can satisfy yourself, right? Because that's negative 1 over x squared, that's 1 over x, and then you multiply it out, it turns into 1. And what Mehra and Prescott got was that actually that elasticity would have to be 30, which is to say, for example, that a 10% increase in your income would make a dollar worth 30% less than it was before, which is implausible. It's not just implausible. It's implausibly different from what we actually observe in the real world. Okay. So Benartzi and Thaler come along 10 years later, and they use a reference-dependent model to explain the equity premium puzzle. But they have to add a piece, and this brings us back to this whole question of the big picture versus the little picture. They have to add in narrow framing to solve the puzzle. So check this out. this is just to give you, so this is going to bring together the loss aversion and the narrow framing. So this is our sort of standard thing where x is the gain or the loss relative to your reference point. So if I give you this, if I give you a gamble of 50% you gain 200, 50% you lose 100, that obviously has an expected value of 50. The expected utility under this reference dependence model, right, is going to be equal to, with probability 1/2, you get a $200 gain, which we value at just 200, and with probability of 1/2, you lose $100, but because of the loss aversion, you feel that as if it was a loss of 250 utils. And so the expected utility, because of loss aversion, is negative 25, right? So the loss aversion really kicks this thing into the gutter. Now let's ask another question, which should begin to look a little bit like holding a stock portfolio, which is, what if I offered you the same bet twice in a row, and you have to decide whether or not to take the two bets simultaneously? Like I'm basically asking, would you like both bets simultaneously versus both bets one after the other versus no bets at all? Okay, take it or leave it. 2 bets in a row, 2 gambles in a row. And what you get, and you can convince yourself of this with a decision tree, right? You have heads, tails, and then heads, tails again, heads, tails again, right? And what you get is, you don't necessarily have to write this down. So if you get double heads, you get 200. You get $400, right? Because you win the 200 twice with probability of a quarter. In either of these two outcomes, you're going to get $100, right? Because this is gain 200, lose 100. And each of those has probability of a quarter. So the probability of that $100 outcome is 1/2, right? And then here you lose 200 with probability of a quarter. So that's the distribution that you're facing now. It's now a sort of a 3-outcome distribution. And the expected utility under this reference dependent model is 1/4 times 400 plus 1/4, plus 1/2 times 100 minus 1/4 times 500, right? Because it's a $200 loss times 2.5. Right, so the 400 is a gain, the 100 is a gain, the negative 200 is a loss, and that's equal to 25. Okay, so if I give you these two gambles together, you should be looking at the final outcome of the two gambles together, right? Like imagine that I say I'm going to roll these dice or flip this coin inside a box twice in a row, and I'm not going to tell you each of the outcomes. I'm just going to tell you the net outcome. Okay, at the end, then what happens is that much more probability winds up on gains than on losses. Right? We're sort of like smoothing out the distribution so that much more of the time you're going to net out with a gain, and so loss aversion has less bite. Okay. But, and this is the take-home message here, is what if you felt, whatever that means, what if you took into account or experienced the gain-loss after each roll, right? So I flip the coin, I roll the dice, and you lose $100, right? And then you're like, is it lose 100 or 200? You lose $100, lose 200, and you're like, oh, I lost 200. Then I roll it again, and you gain 400. What am I doing? Gain 200, lose 100. So I roll it, you lose. Oh man, I lost $100. Roll it again, you gain 200. Yeah, I got ahead. I roll it again, you lose 100. Oh man, I lost. Net outcome, no change to you, right? But you're sitting there, go Cowboys, or whatever. So then what you would be looking at is that you'd actually be faced with an expected loss, an expected utility of negative 25 each time, and you would say, oh no, I don't want that prospect of having that loss aversion time after time after time. So this is what's called narrow framing, right? So we typically have one of the implicit assumptions in standard microeconomic models is that people make decisions based on like their entire. People make sort of all of their choices in the context of all of their other choices. Would be one way of thinking of it, right? So I'm going to make my choice about this gamble in the context of the fact that I'm already facing all of these other gambles, or that if I choose this set of gambles, I will face them together, right? And what we see is evidence that that's not what happens. So someone who would reject the double gamble twice in a row is basically violating the standard model in yet another way, right? By making each choice based on the outcomes of just that choice, rather than sort of netting it together with all of the other outcomes that they're faced with, or all of the other gambles that they're faced with. Do you want to turn that frown into a question? Yeah. Okay. If it resolves itself into a question in your mind, you'll raise your hand, right? All right. It's on the problem set, so you'll get it by the end of the day or by the end of the week. Okay. So this is the way to think about this in the case of the equity premium puzzle. What Thaler and Benartzi, or Benartzi and Thaler rather, posited was this. What if investors experience gain-loss utility whenever they check their stocks, right? So checking your stocks is like seeing which way the coin came up today. The more frequently that they check, the more likely they are to feel a loss, right? So if you're invested in a portfolio that over time has a positive rate of return, eventually, if you just wait long enough, you're very likely to see a net gain, right? But it's up and down every day. So if you check it every day, you're much more likely to see a loss. And if you experience the utility, right? If the psychological impact of that is in response to seeing the paper gain or loss, then loss aversion is going to kick in on this very frequent basis. Now, using a typical reference dependence model, by which I mean they actually went and took the model from prospect theory paper and inserted all of the parameters based on a whole bunch of empirical evidence that's been used to parameterize that model, what they came up with was that if investors check about once a year, then that model, that sort of what is now the standard behavioral model in some sense, predicts a 6% equity premium. So they took a model and they plugged in different frequencies of checking your stocks. And what they got was that if you check your stocks about once a year, which if you're investing for your retirement, it doesn't matter whether your stocks are going to be up or down next year, right? Until you're really old. But if you're getting this gain-loss utility just from seeing paper losses about once a year, you can explain the equity premium puzzle. Okay? And if you don't have all of those assumptions, right, the standard model can't remotely explain the equity premium puzzle. Now, mind you, experiencing utility from checking stocks is yet another violation of the standard model, right? Because you're supposed to get utility from consumption, right? Which is to say, after you've sold the stock and spent the money on something is when it's supposed to affect your utility function. If you've ever invested in stocks, indeed, if you've ever played any game that involved a pair of dice, you know that that's not how we think. We get that. It's like a punch to the gut when your portfolio's down. Okay. Now, showing that a model can explain an anomaly does not prove that the model is correct, so we typically turn to laboratory experiments to provide additional evidence in support of the model, right? So the fact that the standard model can't explain the equity premium puzzle means that we know for sure the standard model isn't right. But to show that Bernardsky and Thaler's model of reference dependence with loss aversion and narrow framing and utility from paper gains and losses, to show that that can explain the results, that it can explain the equity premium puzzle, doesn't mean it's the right model. There might be some other model that does a better job. So we turn to the lab to see whether we can actually find sort of like some exogenous experimental variation in how often people check their stocks to see whether that part of the Bernardsky and Thaler model works. So this is the same list. I don't know who Hay is. This is the St. John list. So subjects were given 100 tokens, right? These cash equivalent tokens, and they were allowed to sort of in this mock investment market. You can give however many of your 100 tokens you can use. You can invest in the following bet. With a 1/3 chance, you get 2.5 times your bet. So, right, so this is a firm that 50% of the time returns 250% on the dollar, and with 2/3 chance, the firm goes bust. Okay, and you get nothing. And the bet was offered 9 times in a row, right? So you're being asked, how much do you want to invest in the opportunity to face this bet 9 times in a row, not how much for each bet. You're not being asked incrementally, do you want to make a bet again, do you want to make a bet again? You're being asked, how much do you want to invest in a string of 9 of these things? Okay, so this is like monthly returns or annual returns or something like that. And then you had 2 groups. You had the frequent feedback for whom the payoffs were reported, not received, but reported after every round, and the infrequent every 3 rounds, right? So in the infrequent, they went and they like rolled the dice behind probably literally behind a piece of cardboard 3 times, and then reported the results, and then said, okay, hang on, I'm going to do it 3 more times, report the results, 3 more times, report the results, and then you get the net of all 9, okay? 2 different pools of subjects. You have undergraduate students and professional financial traders. The results in the students. So the result here is the subjects in the frequent feedback, how much they invested relative to. That's kind of like the September 23rd. That's supposed to be I. So the subjects who were faced with the prospect of seeing feedback after every round invested 81% as much as subjects. So they invested less than the people who saw the feedback, who saw the outcome less frequently. So basically, this is saying this is the frequent is people who check their stock portfolio frequently. The others are the infrequent is people who don't check as often. And then among traders, it was even worse. Okay, so now we really know that participating as a professional on a very high frequency basis in a market that is essentially this choice over and over again actually makes the matters worse. Okay. All right. I think I want to do this. Okay. Yeah, I think I just want to do this with the remaining 2 minutes. So what are the experts? These are investment experts. So these are a couple of academic finance economists, Fama and French, who went into the business of giving people advice. They have a blog, they have a website. Fama, I think, is the sort of more tough-minded of them. He says there never was an equity premium puzzle. A puzzle comes out of a simplified economic model, expected utility, that says the average spread of the equity market return to the T-bill return has been too high. It's easy to show that this simplified model is silly, right? So he's acknowledging that the expected utility model is silly. French, his counterpart, some researchers have tried to explain the puzzle by arguing this or arguing that, Bernardsky and Thaler offer a totally different solution. They argue that the problem is the expected utility framework, and they give this other explanation. And he says this: when I think about my own preferences, this argument seems reasonable to me. So you heard it from the experts. Bernardsky and Thaler have captured psychologically realistic phenomena, put them into a mathematical model, demonstrated that it can explain reality. And then, I don't want to dwell on this now, but it's a really important question for us to ponder. If the experts think that reference dependence is a better model, why don't they use it? Because they don't. And we'll come back to a lot of reasons why that is, and we'll start talking about that next time. Oh, sorry, let's do this, because there's then this other clicker. Just everybody press a button. So you get your participation points, because usually I don't put an I clicker on the last slide. Okay, enjoy yourself. See you on Thursday.